Well, welcome everybody. I want you to imagine that it is 1993 and you're standing on the floor of the New York Stock Exchange and a small group of innovative financial technologists ring the bell that morning for the first time. And what they're launching is relatively unremarkable. It's just a fund, State Street, S&P 500 ETF. And in that moment, what feels unremarkable changes the investment markets forever, because that was the first exchange traded fund in the world. And for the first time, ordinary investors could get access to the performance of the entire stock market in one click, efficiently, transparently, and at a fraction of the cost. That world first ETF, that small piece of innovation, reshaped the way the investment markets would operate all over the world. For the next decade, the ETF market grew tenfold, trillions of dollars poured into ETFs. Access, which was previously reserved for institutions, now became mainstream. And now we are standing on the precipice of a similar point in time. The only difference is, this time it's bigger. Because this time we're not talking about the public markets at all. We're talking about the private markets, the fastest growing segment of the investment landscape, where arguably the most exciting, the most interesting companies are being built. And this time, the barriers to innovation is significantly lower than it used to be. With advances in technology, including AI, which we'll get to later on, allowing us to do things in a way that's never been possible before. We're very clear about what that opportunity is. And we're very clear about the role that VentureCrowd will play in the transition from public to private markets. But let's start here. If you unpack the data on the investment markets for the last decade, one thing becomes very, very clear, and that is the investment markets are undergoing a massive shift from public to private. The public markets at the moment, the listed markets at the moment, are declining at the fastest rate in 25 years, according to JP Morgan. As more companies stay private for longer, arguably the most interesting and the most innovative companies, the public markets no longer give you diversified exposure to the true universe of corporate stocks. If you want that, you have to invest in private. And that's exactly what is happening. Investors across the spectrum, from retail through to the top end of town, are redirecting capital to the private markets en masse, looking for greater diversification, higher returns, and more direct ESG outcomes. And for that reason, the private markets over the last 2 decades have continued to grow spectacularly. These forecasts suggesting 21 trillion by 2030. I think it's going to be significantly greater than that. You know, when you compare these two charts against each other, the movement in the public markets versus the movement in the private markets, I don't think it could be clearer where the investment markets are going next. Public markets in decline, private markets on the incline. The only way to get diversification into your portfolios is to have a strategy around private assets. As the investment markets undergo this massive global shift, not just in Australia, but all over the world, from public to private, millions of new investors are demanding mainstream access to all sorts of private assets, venture capital, property development, private credit, managed funds. But the question is, how will they get it? According to ANU research, the Australian National University, there are 3.25 million eligible wholesale investors in Australia as at 2021, This is 2021 figures. They're the most recent figures that we can point to that are validated by independent research. That number is significantly higher today than it was back in 2021. Of that group, 690,000 odd are considered high net worth individuals. That is, people with investable assets of more than $1 million. Those people typically have access to alternatives. The other cohort is SMSF trustees. There's 1.2 million members managing over 1 trillion Aussie dollars. Their access to alternatives, their access to privates is mixed, but then there's still 1.4 million eligible investors that sit in that group. They're eligible wholesale, but don't have institutional relationships, don't have minimum check sizes that get them in the door. And so the question becomes, as the shift from public to private continues, and as the mainstream demands curated quality private assets, how will they get access? The only way to service that group will be through platform technology. And that is what we have been building for years. For this exact investor cohort, for this exact moment in the transition of investment markets from public to private. VentureCrowd is a digital investment platform for alternative assets, and we focus on 4 asset classes: venture capital, property development, private credit, and managed funds, to provide access to as many investors as possible, as seamlessly as possible, by providing that access digitally, by reducing minimum check sizes, and making the entire customer experience as seamless as possible. It should feel like you're ordering a pizza, but below the hood is where we hide the technical and regulatory complexities that are involved in the curation and origination and due diligence and management of private market assets, which everybody in this room knows is not as simple as ordering a pizza. But in relation to the venture capital side, let me give you an indication of the kinds of companies I'm talking about. This is a company called Ingenic. Ingenic is a cancer therapeutic rolled out of CSIRO. They came to us and raised $5 million within 5 weeks on the VentureCrowd platform. This company is on track to become a $1 billion company, but you can't buy Ingenic shares anymore because it's not listed. The only way you could have participated in a company like this would have been to invest early and to invest through platforms. This is 4D Medical, also raised money on the VentureCrowd website and exited by listing on the ASX 18 months later at a 295% return for our investors, which is an exceptional return. You can buy 4D Medical shares now because they're listed on the ASX, but you'll never get the value uplift that was available to you while that company was private. And thirdly, this is Morse Micro. So just recently raised an $88 million round and are now valued at $500 million. Morse Micro now has in it institutional investors at the top end of town, here and globally, as well as major family offices, including the Turnbulls. But when VentureCrowd investors invested in Morse Micro on the platform, it was valued at $40 million. I think it's difficult to dispute the fact that the investment markets, the global investment markets, are moving from public to private. Millions of new mainstream investors will be looking for ways to access private market assets in venture capital, in property development, in private credit, in managed funds. And they will need a way to do that that is seamless, that is digital, that is fast, that is what they come to expect from the way services are delivered in any other part of the market. So what's about to happen over the next 12 months is going to address that issue, service that need, and create a brand new way of operating in the investment markets that doesn't exist today. This is a moment where those that see it early will build generational wealth. 12 months from now, this will be an old story. Today, you're at the beginning of something that we think is very, very exciting. You know, there is something really beautiful about democratizing private assets. I came from a relatively modest family as a kid. We didn't have a lot. So the idea of being able to bring to the mainstream the ability to earn the kinds of returns that private assets allow you to generate and to remove those barriers is a very, very exciting personal mission for me. If this resonates for you at all, we invite you to join the team.
Some people actually ask, what is angel investing? Because it's not as common as what people think. Really, it's an individual person who provides private capital to a business in exchange for convertible debt or equity. It's investing at the earliest stages. Got to stare it on the spot. It's investing at the earliest stages, and it's super high risk in nature. I want to talk a little bit about the evolution of angel investing over the years. It used to start with an individual person investing solo by themselves. They would generally write a check for $100,000 to $200,000. They would do a handful of these investments. Due to the high risk nature, it would generally fail. And when they'd say, this stuff doesn't work. It's not a great experience. We then evolved to angel groups, which was coming out of the GFC across Australia and a lot of other markets globally. Syndicates got together and groups of people said, well, actually, multiple minds can actually get a better decision as they're actually working through and doing investments. And they started investing together, which actually lowered the threshold for people to get involved in angel investing. But it still requires a significant amount of work and investment of time and resources and expertise to actually make those investment decisions. And it's quite hands-on and quite intensive. The market then evolved into angel syndicates. Slight variation to angel groups, whereas what people would do is back almost a single person doing the due diligence, doing the work. It's almost like a fund, but you're backing the single person. Often in a structured vehicle so that you could do a very, very small investment to get more diversified through that. But you still had to go and assess the person you were backing to do the work You had to rely on the fact that that person was going to be around and be interested and stay involved in what was possibly going to be a 5 to 10 to 15 year investment period. And then we move to where we are today, where what VentureCrowd is doing, which is democratizing venture capital. We're leveraging the power of the angel groups, which is multiple people being involved, and then we're letting people back those on a diversified basis on a more passive arrangement, not having to rely on a single person and therefore getting access to a group of people. The chart on my left, your right, shows you the growth of the ecosystem. This is a chart that Airtree put together, which is companies that are worth more than $100 million, starting by the decades of where they were. So the 90s, then 2000, 2010, and then 2020. And you can see a proliferation of companies because this ecosystem is growing and there's more and more money in the ecosystem. And as more money comes into the ecosystem, more startups grow, more expertise, and the whole thing feeds and becomes a bit of a virtual circle. So how does Sydney Angels actually work together? It's a group of 80 to 100 people who work together to actually co-invest in deals and actually do due diligence. Deals come through the year. We get 30 to 50 applications every single cycle. There's 6 cycles a year. The committee and the deal team review those. They filter those down to what they think are the 6 best possible deals. And then those 6 deals pitch to a deal screening meeting. We then filter those 6 deals to what they think are the 3 next best deals. Those 3 best deals then pitch to a full members meeting, and then a syndicate forms around those deals and actually does due diligence. And then out of all of that, 1 to 2 of the 3 will get invested in over a period of time. The group exists to try to help people. The group exists to help source better quality deals, make better decisions, and collaborate together, educate investors to become better investors, and take advantage of the networks that are there. So we're going to talk a little bit about the sidecar fund. The sidecar fund is what's called an early stage venture capital limited partnership. It's a terrible name, but it's one of the best things that exists for a fund in Australia because you get a really, really rare thing, which is you get tax-free returns. And it's not often that the government lets you make a return and pay no tax. And in fact, it goes one step better, that when you make the investment, they even give you a 10% rebate on the money that you actually put in to actually encourage it. It's a $10 million fund with a maximum ability to go to $20 million. I'm talking about tax-free. It's co-investment. So it's got the exclusive arrangement with Sydney Angels such that every single deal that passes through Sydney Angels that has DD done on those companies, those members then back up their DD with their money. They put their money where their mouth is. And so long as 3 of those members actually invest, the fund will actually co-invest alongside as an appropriate DD process has been done. It's targeting to get 25 to 35 companies. It'll be the companies that have come through the process and any company that's been through Sydney Angels. We're going to target an investment, an IRR rate of return of about 20% per annum. Important to note the follow-on investments are actually the discretion of the committee. Key thing we want to announce is that we've done the first tranche and we've done the close, and Sydney Angels has actually invested in its first company, which is a company called iShield. See some details in there. It sounds a little bit corny, but they invented something called the kidney pajama. And it's a little medical device that actually goes around the kidney as it actually goes through a transplant. And it keeps it at optimal temperature during that surgery. It's low cost, it's really, really high margin. It's targeting the US market where there's 30,000 transplants per year. So that's worth about $150 million worth of revenue potential per annum just for that US market. They've got a granted patent in Japan and going through PCT phases in other markets. And they've got a clinical trial underway. The other one there you can see is a range of logos there of other companies that have been recent investee companies that are high growth, high potential, and are likely to be raising further funds in the future, of which the sidecar fund will have a co-investment opportunity in there. So you've got some other biotech type companies, software companies, AI companies. There's a whole lot of fantastic companies in there. What does that mean?
The Sydney is like the heart of Bunter.
As lead investors and partner transition and allowing us to not only raise your funds, but also in allowing us to exceed our divergence and raise awareness of that's who we are and what we not do.
So that was Jeremy from iShield. You can find out some more information on the QR code. We'll be around to talk a little bit later, and I'll pass it on. Thank you.
Good evening and welcome to today's property presentation section of the Capital Markets Showcase. I'm going to talk about property's place within a portfolio allocation, concentrating on the development stack because that's primarily what we do, using some real world examples that VentureCrowd has in the market currently. Property, of course, offers a broad spectrum of risk-adjusted returns, from passive income generation to more active investments in the equity and secured debt layers of property development projects. These opportunities, of course, have been generally gated, often requiring personal or other institutional relationships, often sourced through brokers, sometimes through pooled funds, often with large commissions and high minimum investment amounts. Property investment can offer solid portfolio diversification, and residential development returns are driven in large part by the performance of particular locations. And as you will see, we're very strong on the southeast Queensland property story. That particular market has seen some of the best capital growth probably anywhere in the world. Private direct property investment through VentureCrowd can and has generated returns in the range of 10 to 40%, depending on the project level of risk versus security. It's an attractive option for investors seeking higher growth returns as part of a mix. We've returned up to 40% for some of the equity tranches that we're given in some of our projects. Pref equity, we've generally targeted between about 12 and 18%. The lower ones on these generally represent timing in a lower interest rate environment. At the MES second mortgage stage, between 12 and 20%, and I'll talk a little bit more about one of those products coming up. And first mortgage stage, generally between about 9 and 12%. The property team that we have at VC is comprised of experienced development managers with about 100 years of experience between us. That doesn't mean we've got a heap of people. It means we've got a lot of experience with quite a small team, actually. So, we've got a number of live projects underway currently. We have different offer windows that do open and close depending on the project funding requirements. The second mortgage we have at Cumulus Carrara, which is open now. I'll concentrate on soon. I'll talk about that. A particularly interesting one we've got at the moment is equity in Morningside, top right, and also Moggle Ferry Road. Morningside co-living is a particularly interesting opportunity. It offers exposure to development and the ability for ownership as well. Its returns when it's operating will be about 6.75% net, growing to almost 8% by year 5, and that is net on a residential opportunity. Please do find me after the showcase if this one interests you, because that's something that requires a bit more conversation. Some of the closed opportunities examples include equity in pref at our 46 townhouse development in Albany Creek. Offers are closed and we're repatriating about $11 million of principal and interest, actually beginning effectively tomorrow, next month. And we've got equity and debt products on Glenvale, which is our 324 lot residential development in Toowoomba. It's about 50% sold. It's closed for investment currently because the first mortgage and the equity already invested will take us to the end of that project. Equity and P&I is progressively paid down at each stage settlement.
You'll see from these projects that our investment thesis has been laser focused on the southeast Queensland, and particularly the project I'm going to talk about now, which is Cumulus at Carrara. It's on the Gold Coast, and Michael Matusik, who's one of the foremost property economists, identified 7 core criteria underpinning an upcycle. The Gold Coast had every single one of those, namely population growth, employment growth, rising wages, undervalued housing, a supply shortage, a balanced demographic mix, and lifestyle appeal. Many of you will have seen that Gold Coast average apartment values recently overtook Sydney. Coupled as well particularly is the dire undersupply of land in the Gold Coast region. Resale house listings are sitting at only 4 months supply, apartments and townhouses even worse at 3.6 months. So the project I'm going to focus on now is Cumulus at Carrara, where we're open for investment in a second mortgage product, offering 20% per annum with redemption of the facility, targeted to commence the third quarter of next year. Cumulus comprises 59 luxury houses in a gated community on a ridge overlooking the broad beach skyline. The beach, Pack Fair shopping centre and numerous golf courses are only about 10 minutes away. Cumulus includes a common rec facility with tables, barbecues and a 20-metre long infinity pool. The entirety of our site is over 27 hectares, of which only 3 hectares is developed. The remainder contains walking tracks in that native vegetation, allowing residents to exercise and walk the dog. Civils are complete. Our experienced builder DevCon is on site piling and slabbing with framing imminent, and completion of that first stage of 23 plus the rec centre, as I said, is scheduled for the third quarter of next year, and that's when redemptions of that second mortgage are targeted to commence. We're offering a mix of luxury 3 and 4-bed houses, with some of the 4s having 2 master bedrooms, 1 up, 1 down, allowing for separated disability or intergenerational living. Most importantly, the prices range between about 1.5 million for the 3 beds to just over 2 million for the 4s. That's about 7,200 per square metre, or about half of a new non-beachfront apartment on the Gold Coast. So in other words, for the same price as an off-the-plan non-beachfront apartment, you'll get about double the house area, you'll get an extra car, you'll get all that bushland. On the funding side, the equity for this project was closed oversubscribed some time ago in just a few weeks. And our first mortgage is in place with a group called JVL, the Van Lieshout Group, some of you may know, and it's in place until the end of the project. We're not required to make pre-sales as a condition of the funding. Nevertheless, to ensure we commence payout of the second mortgage facility on settlements of the first stage next year, we've commenced sales with contracts, with a number of contracts in place already. We only need a very modest sales rate of under 2 sales a month to sell this stage out. In the project, it's, as is always the case, VentureCrowd's profits at risk first, then unit holders further up the risk curve in equity before the second mortgage. Gross profit on current revenues post-debt is forecasted just over $15 million. Pretty well all major costs, including the build contract especially, are all now locked in, and we'll keenly look to drive revenue increases during construction, like we always do. At Glenvale, the large project you saw top left at Toowoomba, we were able to push those prices about 30% in 18 months. And at Albany Creek, the townhouse development on the bottom left, we raised prices by over 16% or 150,000 for a 3-bed townhouse in about a year. If we were able to do that across the project at Cumulus, that'd be another $8 million in revenue. As stated, the equity and first are placed. The second mortgage fund is the final opportunity for investors to have exposure to the project. After repayment of the facility, the first mortgage and equity are forecast to cover project costs for future stages. As I said, the fund offering 20% per annum is open for investment, If you'd like more information on the project or the fund, you can use the QR code that you can see on the banners back there or here to register your interest. One of our team will be in touch, or you can, of course, register privately through the VentureCrowd website inquiry. So thank you. That is a little case study on how we do property in the private markets.
Well, hello everyone. Thanks for joining us. We're almost at the end of the evening, 2/3 through maybe. My name's Rebekah Blake. I'm the head of compliance and investor relations here at VentureCrowd. And also, I forgot the clicker. I knew there were too many things. Oh, Dave, I've gone the wrong way. This is us. So my team looks after investors post-financial close. And in my view, yes, you've got the piece at the beginning, but actually that's where the real relationship begins. So our job is somewhat complex, but I like to try and make it simple. We want to make sure every investor knows where their money is, how it's performing, and what is the next step. Now, as part of my role, I also lead the compliance committee. None of this we can do without an AFSL, so it's a really important part of our business, essential. I review compliance plans, manage the KYC and AML, liaise directly with ASIC, and ensure every part of our multi-AFSL business runs to best practice standards. So it's certainly not the flashy front end that you see here tonight, but it's what keeps everything running smoothly, transparently, and of course also compliantly. And for me, I love an empty inbox because that means that our investors are really getting the clarity that they need from our regular communications that we send out to all of our investors in every fund. Now, excuse me, in that particular vein, I would like to introduce James. So obviously, this is not James's real name and not his photo, but he's very much a VentureCrowd investor, and this is his actual story. So we essentially are James's private market strategy. Now, James joined VentureCrowd in January 2022. A month after that, he invested in the preference equity of a property development project in southeast Queensland. That returned 12.5% per annum, which was paid monthly in arrears. It's pretty simple. Then in March, he invested into the equity that Dave just showed before of a property project in Carrara on the Gold Coast before the boom. So the forecasts hopefully saying that he will do well there. In April 2022, he dipped his toe into venture capital for the very first time, which is what's really interesting about this multi-asset platform. And he invested in an Australian medical device company called Neopharma. Now, having an interest in health himself, he then invested into the VentureCrowd Health Tech Fund. So that was also a first for James in investing in an actual ventures fund. He then took a stake in Nextbar. So that's a consumer goods company with kombucha that you probably see on the shelves of Coles and Woolworths. And then in February 2023, which was his sixth investment, he invested in a first mortgage fund providing construction finance for a residential subdivision that you saw before in Glenvale. So today, James holds 13 investments with VentureCrowd that total 2.2 million and has seen returns of over 883,000, including an IPO. So in short for James, VentureCrowd is his private markets portfolio strategy. Now, we think that that's the power of a multi-asset platform approach, which is diversified, he's kept informed, and it's equals compliant. And James is a great example of how that strategy for private markets works. Now, for me, over the years, I've spoken with hundreds of investors, and the clear trend is emerging, like Jack was showing before. Wholesale investors are increasingly allocating to private markets, and often they're actually doing so without consulting their advisors first. So I know there were some advisors here in the room. But advisors, I think, are really crucial to this shift. Now, the opportunity, I think, for advisors that are in the room here is to keep your clients close, by giving them the private market strategy, giving them the curated, compliant and high quality deal flow that you can trust for them. And that allows you, the advisor, to provide oversight and, of course, strategic guidance that they need for their portfolios. But alternatively, if you are a wholesale investor that's confident about building your own strategy, like many of you here tonight, and of course like James, then VentureCrowd or any other trusted platform that gives access to private markets should of course be key in your overall investment strategy. Now for VentureCrowd, we think we bridge the platform between those private markets and professional advice, giving investors the access that they do want and the assurance I think that they need. Thank you.
And now the moment you've all been waiting for. But thank you, everyone. That was excellent. I think that was a good foundation for how we'll end the conversation tonight. And first of all, thank you for your time tonight. Head of AI at Optus. You can have a lot of idle time in your day, so really appreciate your time. Tonight we're gonna have a little bit of a real conversation about Agentic AI. There's a lot of hype, there's a lot of speculation, there's a lot of talk about what is AI, and in the context of private capital markets, that's even a deeper conversation, right? So we'll take you through sort of the chats that we normally have, Jesse and I. And maybe let's start with the first question. I just came back from San Francisco. We were invited to the largest tech conference in the world, Salesforce Dreamforce, mainly because we were some of the pioneers in building agentic AI solutions in the Salesforce ecosystem. And what I tell my team is, I feel like I came from the future. The conversation is really advanced there. There are many steps ahead, and it feels to me like they've gone past the might we implement AI? How do we implement it? Should we consider implementing agentic AI? Feels like the conversation has already passed those steps, and it's now more how do we do it in a way that's trusted, that's reliable, that's repeatable. Where do you think Australia is in that curve of innovation and adoption?
Perfect. Well, thanks, Diego. Thanks all for your time this evening. I think what is fascinating about the Australian market when it comes to AI is that we're actually seeing this huge shift, which is to say that it felt like a year ago, the conversations were about, is this thing real? Is this just the next big tech trend that is going to disappoint us? And I think what we've seen over the last 12 months is a real explosion in not only new businesses emerging that are building their products and their platforms with artificial intelligence at the core, but also large enterprises beginning to use it and to understand the value and the implications of AI to the products and services that they offer. And so at least what I see is that we're actually at this point, which is to say everybody's now extracting value from the technology, and the questions are beginning to shift to not about should we do this, but how can we do this faster, and how can we do this safer? And so I think we're at this inflection point where we're going to see this huge shift in focus towards acceleration using AI, which I think poses many opportunities in the Australian economy, but also then poses many risks and challenges around the implications of the technology to our economy and to our workforces.
Yeah, that's right. And that's sort of what I saw in the future. I noticed that, it's all about speed now. It's all about how fast can you move, how the velocity that you can keep in innovation. And we've been deploying agentic AI solutions for 3 years now, before agentic was a buzzword. And early on, we realized, and what I've noticed over the past few years is you either focus on automation or you focus on augmentation, or you focus on a mix of both, right? So humans with AI in collaboration. Where do you see that taking shift in the private capital markets, and where do you think companies should focus on?
It feels like at the moment there's I think a lot of dreams around like pure agentic AI being able to automate process and workflows end to end. However, I don't think we're there yet. And I think really where we're at with AI is that it's a tool to really enable, to empower, and to supercharge people in our teams and in our workforces. And so when you think about the ability for it to help with somebody in marketing, being able to develop content or collateral, to go find the right audiences for content, jobs and tasks that may have taken days, weeks, months, in some cases years for large organizations, can be done in seconds and minutes using the technology. And so I don't think it's a case of letting the technology do it itself completely, because I don't think we're quite there yet. However, it's how do you help supercharge the people inside our businesses, inside our workforces, to get more done using the technology.
Supercharge is a word that you use a few times, and I could go in many directions here, but specifically in private capital markets, how do you think agentic AI and AI will supercharge specifically private capital markets?
So I guess my view on this, it sits at a couple of different layers. I think first is that for investors, they can make the process of investing simpler, easier, and faster. The ability for you to now conduct research, find new investment opportunities, and then to be able to understand the implications of that on your portfolio, forecast the future implications, can be done in, again, seconds of units. Jobs that may have taken weeks, months of efforts, or the best efforts of teams of advisors supporting you, can now be done instantly. Even while I was watching Steve's opening and looking at some of the figures on high net wealth individuals of Australia, wrote a prompt, had ChatGPT 5, the deep reasoning agent, review 172 sources of economic data that exists in Australia, international research on high net wealth individual market movements, the value at stake, and came back and validated all Steve's figures. So kudos, Steve. But it's an example of that, of having a team of experts being able to connect to data in real time, sitting in everybody's eye. And so I kind of go for the investor, the game changes instantly, which is to go, a lot of the information asymmetry that we may have had in the past disappears. But then for people in the shoes of being at the issuer, all of a sudden the ability for you to access private capital and to diversify your access to private capital actually again becomes simpler, easier, and faster. Like your ability to now set up campaigns, be able to engage investors, and to engage them in truly personalized ways, not just big blasts or knowing people and kind of giving the nudge on the deal, but actually being able to use digital channels to do this at scale opens up so many opportunities to make the whole ecosystem, again, better, faster, safer. And I think that's the big opportunity, is that when we connect both those things, unlocks so much growth in the economy, but also then huge opportunity for issuers and investors at the same time.
Unlock is the other keyword they use a lot, and I feel like agentic AI is unlocking full potential of humans, of economies, of companies. Private capital markets have always been about human relationships, as you know, and who you know and who you talk to, and the human aspect of it. How do you think the embedding of agentic systems and AI systems in private capital markets will evolve to keep some of that humanity and, but taking it to the next level?
It feels like it'll do one or two things. I think for many relationships that exist, actually strengthens. And I think, again, it comes down to that ability for the machines to be able to help you with analyzing vast amounts of data, being able to help you assess opportunities. And so instead of us sizing each other up or we're meeting each other, all of a sudden you have access to fact, knowledge, data, intelligence. That means that the relationship that you have, like many of us are forming in the room tonight, become even more important. Simultaneously, though, I think there's a new class investor that is emerging, particularly in the Australian economy, that are digital native. They are being brought up using these tools and these services as part of their everyday life. And so You think about that in the context of the private capital markets, it's materially different to the way that they've operated in the past. And so the ability to have them have access to the private capital markets through digital platforms that are always online, always available 24/7, the ability for them to do it from the comfort of their home, their bed, or wherever they are on holidays, the ability for them to not speak to a human in the end-to-end journey also becomes possible with platforms like VentureCrowd, but this shift as well. So I think it'll do two things. I think it'll strengthen relationships and in some ways make us more human with each other, but then inversely also take the humans out of the loop and open up more opportunity at the same time, depending on, again, your experience and your preferences too.
Spot on. I think it helps us, spend less time on toil and more time on the things that add value and the things that you're really good at. Now, I'm really conscious that I am the last person holding you back from a glass of wine. And I've actually never had a 10-minute conversation with Jesse, ever. Normally, we would lock a room for 4 hours and talk away. So I'm really holding back. But as a builder, we always like to compare the innovations that we build. What is the most exciting thing that you feel we're working on at VentureCrowd right now, in terms of AI and Agentic AI that you are excited to see what comes next out of it?
So one of the things that actually hooked me, we first were discussing the roadmap, the technology, and looking at the architecture that Rebekah brought up just briefly before, was actually this, it's quite a simple idea, but it's brilliant. And that is a marketing campaign agent. And having worked in very large enterprises, inside Optus now for a year, before that the Commonwealth Bank for a decade, leading all their emerging tech and innovation, looking at these big processes like marketing and seeing all of the different handoffs, all of the different people that exist in that value chain, mean that this will sound odd to anybody that hasn't worked in enterprise, but simple things like drafting an email and sending it to a group of customers could take 16 weeks.
Compliance, the data team, the data team trying to figure out the audience, scheduling it with the comms team, like getting brand to review, compliance, legal. There are so many different stakeholders in that value chain. And getting to see the way that you had thought about campaign execution using Agentic AI to say, well, what if you were to, in effect, parallelize the process to have all of these steps run by agents all at once and then kick out to a human when it's needed, so for compliance review, but fundamentally have AI help with drafting the communications, developing the asset, doing the data analysis to find out who has the propensity to invest and why, personalizing the communications to them, kicking it out for review by legal, and then pushing the big green button. I kind of looked at that and went, 16 weeks of work in enterprise that I watched get done in under 2 minutes. Incredible. Actually blew my mind. So when you think about that in the context of the platform, when I looked at the issuer journey, which is fundamentally about executing campaigns, the velocity and the capability of putting that in the hands of an issuer on the platform is incredible. And I think that such a core foundational process that you've made literally many, many, many times better. So that to me is like real world example of AI being used to help make something better, faster, safer. In terms of the future roadmap, looking at things like how we start to expose AI to help with issuers setting up campaigns and helping them with positioning, particularly in the venture space. Super interesting, using all of the intelligence of many years worth of deals and transactions to help figure out what works best. Incredible. But then again, also just even some of the core machine learning work around figuring out if it's the modeling from the entire audience base and investor base and trying to figure out what do people want and buy, connecting them to that, I think will help create more journeys like James or Fake James through the platform again and again and again. So
very, very excited, very, very proud to be a part of the team.
Thanks, Jesse. And, it's been an absolute pleasure working with you, and, getting your advice, your feedback. It's been super valuable. I think I just want to end with one note. For us, when we talk about agentic AI in the context of private capital markets, it's not just deploying AI for the sake of AI because it's trending. I genuinely believe that it will be the greatest advancement that we can have in unlocking private capital markets and providing access at scale. Technology has been and will continue to be the greatest enabler in that kind of progress and access. And what we're seeing with AI is something that we've never seen before, and it will accelerate things dramatically. And for us at VentureCrowd right now, it is giving us speed in product development that we've never had before. So we're really excited about what's next. Thank you for joining us tonight.